Hey everybody, Steve Olson here, and I want to talk about something that we get a lot of questions on. Anytime I'm answering the same question over and over again, I tell the guys, "Hey, let's record an episode on this to, lighten the workload a little bit." And here's the question. I've talked on this show before about the various methods that you can invest in real estate through the Peak Group. One of those, and probably the most popular, is the CO method, where you buy a property that's completed. And people love it. The property is mostly de-risked at that point. You know the cost, you know the rents. It's a very quantifiable thing. The downside to it is you're going to be paying close to, if not full market, for something like that, because we had to borrow money. We had to get it all the way to the finish line. We want to be compensated for that, right? So sometimes investors approach us a different way through what we call the investor build model. And this is where we bring finished lots to the table for either single family homes, duplexes, or fourplexes, or something like that. And we sell you the lot along with the plans to use the Peak Group's construction arm to build you that fourplex. And most people do that via a construction loan, which JT, who I've had on the show before, can assist you with if you need to use a construction loan. We've had a lot of people build all cash right now because they just don't like the interest rates associated with construction loans. So they build all cash. They just fund the money to the title company. And that's what we draw on to build your units for you. But then when it's done, they're going to reevaluate what their refinance options are at that point. But they saved, like a year's worth of interest, which is probably close to double-digit interest rates right now on that construction loan. So, many people do that. And the question I frequently get is, well, how does that work with a 1031 exchange? If you've had a capital gain and you're trying to exchange into a Peak property via investor build, there are a couple of things to think about. One of the first things that I always say to an investor who's contemplating a 1031 exchange is, have you talked to your CPA to find out what happens if you don't do the 1031 exchange? Most people have. They already know what the scoreboard is going to say if they don't exchange, but you actually would be surprised as to how many people haven't. They just think, oh, I got to do it. I sold the property, so I got to do a 1031 exchange. You actually don't. The question is what's it going to cost? And sometimes when somebody goes to their CPA and says, hey, I'm thinking about selling my property for X, and he looks at their tax return, all the schedules on there, and he can come back and tell you, yeah, if you sell your property for $500,000, you're going to owe the IRS 90 grand in capital gains and depreciation recapture or whatever. And for you, you might say, ooh, 90 grand. Well, then, yeah, I'm going to do a 1031 exchange. But what if your accountant came back and said, you're going to owe 9 grand, right? Sometimes I hear some pretty low numbers and people go, oh, you know what? It's a relief. I don't have to go find something, because sometimes people do rush into deals for a 1031 exchange that they would not otherwise do. And so you got to make sure, what is my alternative if I don't find a property that I'm excited about, that takes my hard-earned gains and translates it into something else. I think that's a great place to start. But that being said, what if your taxes are going to be high and you're considering a Peak investor build? This can get a little tricky. One way around it is the opportunity zone thing. I talked about that on a recent episode. That gives you a lot more time and flexibility to get probably better benefits than a 1031 exchange. But when you go investor build, I've been on lots of calls with CPAs, and my disclaimer here is I am not your CPA. I'm not your attorney. You've got to talk to them about this. I'm just giving you a general education on what I've seen. But if let's say you sell your property for $300,000 and you're looking at a Peak property that's $500,000 on an investor build. Here's the challenge, is when you close on that replacement property, most of the CPAs, actually, I'll say all of the CPAs that I've spoken to have said, you can recognize the value that existed at the time that you closed. So if you closed on a finished lot, but no vertical construction has happened, you're only going to get the cost of that lot that goes towards the 1031. Let's say that number is $100,000, right? If you sell your $300,000 property, but you're only getting $100,000 towards your 1031 exchange, you're going to owe a bunch of taxes, even though your purchase price was $500,000. So there are ways that people get around this. One of those is, well, what if I buy multiple properties from the Peak Group? And oftentimes that's the easiest solution, right? We just stack up a bunch of land value spread out over a number of properties and we can accomplish the same goal. And I think that's the easiest, but sometimes that's not possible. Sometimes the equity you're getting out of your sale just isn't enough to buy multiple properties. And so you're stuck scratching your head wondering what to do. So option 2, talk to your accommodator. Some of them don't even know what this is, right? I've seen it happen a few times. The accommodator I mostly use refers to this as a build to suit exchange. And they have a method that they do this, and frankly, I don't fully understand it. So I'm going to explain it very, very simply, which is they take title for you, right? They form some kind of a temporary entity. Once again, I can't remember what it is. And then we go all the way to the 180th day of the exchange, which is when you have to have it completed by. But what they do is they take the draws that the construction company has submitted and they add those on top of the land value. So while your purchase price with the Peak Group or somebody else may have been $500,000 and the land value was only 100, did we get a couple $100,000 in vertical construction during that 180-day period? If so, you might be able to close that gap a lot or even eliminate it and zero out your taxable income from the sale. So I would encourage you to ask your accommodator about a build to suit exchange. It's not always an option, but for some people, it certainly is. So that's another good way to do it. And if none of those options work, you're either going to take the tax hit or you say, you know what options are out there that are fully complete where I can close on and I'm not doing this whole pre-construction thing and I'm taking a hit on that value. It's all about trade-offs. Is the extra money you're paying for the property with a certificate of occupancy worth it? Is it going to offset and then some what you would have paid in taxes otherwise? Because granted, the dream scenario here is you figure out the exchange on the investor build and you get that wholesale price and wipe out your taxes, right? But oftentimes in real estate, there's not exactly a totally clear answer. It's just a matter of trade-offs and you got to decide. Is equity in the deal better for me and I take a tax hit, or do I want to avoid that tax hit entirely and be in a deal for market value? So that's how it works. And I would encourage you, if you're thinking about this and you're talking to one of our advisors, it's always important to understand what is the land cost on a particular deal and what is the vertical budget on a particular deal. What is your timing like? And we can provide you the relevant facts on dates and budgets and things so you can go talk to your tax advisor and say, hey, here's what they gave me. What's my best choice? I hope that helps. Thanks for listening. We'll catch you on the next episode.